Hello, everybody. Hey, welcome to another Capital Gains Tax Solutions Deferred Sales Trust Mastermind, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is an amazing way for you to create and preserve more wealth, defer hundreds of thousands to millions of dollars of tax, help your clients, friends, family exit cryptocurrency, businesses, real estate, because it's no longer just about cash flow, it's about tax flow. And to the extent that you and us, and you can join us, understanding what is available with this deferred sales trust, you have a chance to exit with some freedom. And there's a couple freedoms that we love to talk about. One of those is just financial freedom. You probably know that one, where you have a chance to just replace your income or your expenses, right? And be able to have some time freedom, right? Where you don't have to trade time for dollars. There's also the freedom of location, being able to maybe move and relocate from a high-end primary home or a business that you were in or a state that you want to move out of, and have that freedom of location to spend time with grandkids or to travel. But there's also something called entrepreneurial freedom, where you have the ability to go into a new venture and a new opportunity maybe to go into real estate ventures or to a new tech startup or new cryptocurrency startup, whatever that might be. You might have a huge tax that's in the way, and that 30 to 50% of that gain is going to be wiped out. And if it's wiped out, that decreases your opportunity for these freedoms. And so we're very passionate about equipping you with the Deferred Sales Trust, helping you to execute it and helping you to exit in a wise way. I'm joined by some of the best in the business. In fact, one of my business partners, financial advisor extraordinaire, I call him the CPA whisperer. He is wise beyond his years. Jake Mellor. Jake, how are we doing this morning?
Doing wonderful. Enjoying the great weather back here in Utah. Been traveling the last couple of weeks and glad to be home.
Fantastic. And I think Pierce is also on the line. Pierce York, are you in the house today? And if he's not, that's okay. He's probably on the beach in Newport Beach, just relaxing. By the way, Jake, please do look that we do have the Mazalon sweater in white today. So if you could please next week either wear the black one or get the white one so that you're on the same level, okay?
I need to definitely put on my uniform, the muzzle-on sweater. We had a great time at one of these kind of exclusive events of some of the top realtors in the nation for EXP down in Cabo San Lucas. And it was a wonderful opportunity to sport these sweaters. We just happened to wear the same exact sweater, happened to purchase them from the same exact place without knowing, and just happened to go get dressed for some event in the evening, and we both put on matching sweaters. So we had to make it a thing. We had to ask everybody else where their sweater was, why they didn't belong like we did. And we had a great time with it.
Absolutely. Yeah, they got us on Facebook, one of those Facebook ads. And so we kind of have a format here where we just kind of introduce the vision for why we're here. And then we talk about the deal close story of the week. And then we open up for questions. We also at times have some guests with us to come in and kind of discuss some of the things that they're seeing. Jake, do we have the guest today? Is he on the line?
I'm not seeing him here at this moment, but, we do have somebody from Los Cabos San Lucas here with us today, Candace.
Hi, Candace. How are you? It looks like your screen is to the side there, but...
Hello. How are you guys doing today?
Doing great.
Very good. Very good. So anyway, we have Candace. She's Canadian. She's living in Los Cabos San Lucas, and she's very interested because of some people she knows in Canada who are selling their homes for a few $1 million, whatever. And they might be eligible candidates for something like this down the road. We can talk more about that later.
Cool. Very cool. Mm-hmm. So let's touch on the vision, and then let's touch on the deal close story of the week, and then open up for questions. And so Jake, give us a reminder. What's the vision? Why we're here?
We are here today because a lot of people out there have highly appreciated assets. Some of them, it might be the biggest transaction of their life. Others, it's just, some kind of mainstay portion of their business. It could be real estate. It could be Bitcoin. It could be their business itself. We just talked to an individual here just a minute ago that has a cleaning and reclamation business, a restoration business. Anyway, in regards to these assets that have highly appreciated, sometimes this also becomes a very highly taxable event through capital gains and some of the other taxes that the states and the Obama program and all these other things might tack on top, right? So we help these individuals sell their assets without recognizing the sell it as a taxable event during this year. And they can push this forward, and they can reinvest the gross proceeds net of attorney fees, and they can actually do much more with this bigger piece of the pie rather than chopping it up into small little pieces based on all the taxing agencies.
Absolutely. That's why it's about tax flow, not just cash flow. And as a part of that, we like to use the analogy that every deal is specific and every needs are specific and everyone's goals are specific. And so it's kind of like in a Rubik's Cube where you have all these different colors on different sides. And part of that is defining and clarifying your vision for your wealth plan, for your time, for your energy, for your legacy. And part of solving this has to do with the tax part of it, right? And if you can defer that tax and create and preserve more wealth. So there's the investment side, there's the wealth side, there's the personal reasons to sell or exit an asset. I think about the cryptocurrency world and what's happening right now with with the kind of the big crash here in the last month. Ways to exit when it makes sense, right? And feeling that freedom and that empowerment to be, hey, I can exit when it's high. I don't have to stay and wait for the market to shift drastically. I can take my gains without having to incur the tax by using the deferred sales trust. And the ultimate goal is to try to get something that looks a little more like this, right? Now, it's not always going to be perfect. The deferred sales trust is not a one size fits all. In fact, we'll talk about here in a minute who it really works for and who it's good for. But the goal is to try to align as best as we can as a team, Jake and I and the tax team, and we're even working with your trusted individuals to bring and try to make this thing line up and make sense financially, time freedom, entrepreneurial freedom, financial freedom, location freedom, and then some tax deferral flexibility. But that being said, Jake, who does this work for, and what would you say who is a good fit for?
Typically individuals that have a highly appreciated asset, as we mentioned, but in the transaction size of $1 million or more. Typically $1 million where there's very low basis or $1 million above basis, so that their tax paying is significant enough that this is a no-brainer. It's an easy home run, right? Now, can this also work for people that maybe have a transaction where the net proceeds are less than $1 million, Brett?
I mean, it can. It just all depends. Again, back to this Rubik's Cube. Like we just did a deal in Dallas, Fort Worth. Jake and I did for a client who has a $8 to $10 million net worth, and they were selling their first deal was closing like a couple of weeks. This is a few months back, and it was only $250,000. And so for them, it was some tax for sure. And by itself, we would say no on if it was like a solo deal. But in the grander scheme of things, again, his Rubik's Cube is more complicated than just one asset at $250,000. His ultimate goal is to be like this. He can consolidate multiple assets into one, so it can work. It also depends what state you're in. If you're in California or New York or in these higher tax states, you have more pain. And really, what we like to see is a ratio, a good solid ratio. 20, 25, 30% is a good ratio of tax liability versus net equity that you're closing on. So if you have a $10 million exit and you're looking at a $3 million liability and your $10 million is going to net into the trust, it's a good ratio. Now, if you had a $100 million exit and only a $2 to $3 million tax, well, that's only 2 to 3%. That's not a great ratio. So it's not a one size fits all, but we have found no matter what state you're in and no matter what you're selling, S Corp, LLC, LP, C Corp, if it's a partnership split, get investment real estate, primary home, if there's at least $1 million gain and $1 million net proceeds, then it's a home run. The only little small exception to that is if you've lived in a house 2 of the last 5 years and you're married, then you have a $500,000 exclusion tax-free, which is an amazing thing, or $250,000 if you're single. So again, this is part of why we provide, even right now, and someone might have a live deal, and we're going to open it up for discussion here shortly, where you can actually ask us this question if it's a good fit for you. And we will put our brains together and we'll try to make this make sense. Jake, anything to add to that?
Well, just a deal that I spoke to this morning. There is a 20-plex in Phoenix, and it's a $6 million deal. And there's some intricacies here based on what's going on because the owner is actually foreign. It's a foreign owner. But on the US side of everything, it kind of works the same in the sense that everything that we're dealing with here in the United States, whether or not we recognize the transaction in 2022 as a taxable transaction, that is what the deferred sales trust helps us accomplish in moving the recognition of that transaction forward. And you got to kind of think about it as if this were some kind of qualified account, even though it's not, and it's a different tax code. But most people are familiar with like an IRA or a 401k, where they have assets inside of that and they may buy and sell assets inside of their 401k, every now and then, rebalance, what have you. And those transactions are not taxable. They're not being recognized right now as a taxable transaction. And that's kind of what we do with the deferred sales trust, is we help individuals who are otherwise going to sell a highly appreciated asset now, whether it's the 20plex or your personal residence. And if the tax paid is significant enough, we exchange that asset into the trust. And then that trust can then sell that asset, just like your 401k or IRA might sell and buy other assets.
Yeah, very good, very good. And so that leads into the next part of the mastermind, which is the deferred sales trust deal close story of the week. And this is actually a repeat client. In fact, they are, let's say, so happy or so thrilled with the results so far that this is the fifth deal. And it comes in at their biggest deal. In fact, they started out with a $20 million multifamily property in Las Vegas. And then it went to a $16 million property in Phoenix. And then it went to another deal in Arizona, another one in Arizona. I got to get all of these straight because now we're on the fifth one. Anyways, we're all the way back to Vegas, and it's a $48 million deal. That's right. They did a $33 million deal in Phoenix a month ago, and now they just did a $48 million deal. So now they had partners, right? So this isn't all of just their capital. They had a lot of LPs. So the first thing to understand is the deferred sales trust does work for multifamily syndicators, that even if you have LPs, most LP, multifamily, and GP syndications, they're kind of constrained because the whole partnership generally has to move, which means everyone would have to do a 1031 exchange, which means most syndicators are not doing 1031 exchanges. In fact, I would say 95% of the ones out there are just building or buying, improving, and then selling in 3 to 5 years. Everyone pays their tax. Everyone comes back together. And so they're missing out on the opportunity to defer the depreciation recapture and the capital gains tax of somewhere between, again, 25 to 50%, just depending on what state you're in. And where you're at with that. And so they took their GP positions and they exited. Now, one LP jumped in. So these guys, they had 4 deals they did kind of by themselves. Then now they're bringing in some of their LPs. Now, the LP had a big position. So that was important because, again, of our minimums that we like to see about $1 million and $1 million. So he had a large position. So they were able to all exit into their own individual trusts. So, Brett, did the other LPs just pay their tax? Yeah. And then one LP did his own trust? Yes. And then the 2 GP partners were able to do their own trust? Yes. And that's pretty sweet. They're really happy and they're moving on to the next one. In fact, they're using some of the funds immediately to purchase as a portion of it of their another new deal they're buying, another multifamily deal they're buying. And then a lot of the other funds are just going into securities. So that's the deal close story of the week. You can see that. I just dropped that on LinkedIn, kind of the overview of that. But Jake, anything stick out there? Anything you want to say on that one?
If people compare this to like a 1031, everybody with a 1031 has to do the same thing, whether it's GPs, LPs, regardless. Otherwise, it all falls apart and it doesn't work. So I just point out the flexibility here that, hey, in this scenario, some of the LPs didn't do it. They just pay the tax. One of the LPs did, and the general partners did. I think that's incredibly important that people understand the flexibility here. Again, does it have to be a business asset or can it be a personal asset? It can be your personal home. You just got to take into configuration the formula of that, married filing joint $500,000 exemption, right? Make sure that the tax payment is significant enough. Again, at the end of the day, this is a very flexible tool. As long as you're reinvesting it in the future for something that is not personal in nature, even though it might be a personal asset that you start with, all of these are qualified transactions, qualified in the sense that it works and it's eligible for the DST. Beautiful.
Excellent. Now we're going to open up for questions from anybody and everybody. You might have a live deal. You might have a thought or a question on anything that Jake and I just said. You could just type it in the chat. And if you also type in the chat first name and where you're from, that would be cool as well. And you can unmute yourself. You can raise your hand, all of the above. So what questions do you have for Jake and I on the deferred sales trust? It's got to be at least one. It usually takes the first person to open it up, and then it's like everyone starts going. So who wants to be our first question, thought, comment, hesitation, right? We can bring them up ourselves too, but who? Anybody. Cool. Why don't we go to some common CPA questions, Jake? We had a couple of them this week where CPAs have questions on the deferred sales trust. I had one case working on. Actually, it's already a client. We already closed. He's getting a new CPA, and this new CPA is cautious, is concerned, is not sure on the deferred sales trust and the tax return filing for his new client. And so, questions about constructive receipt, questions about the California Franchise Tax Board notice, and just kind of general questions. So, Jake, when people ask, deferred sales trust, what are some common questions a CPA might ask, and how do we help people get confidence that it's legal, it works, and just in case they have an audit, what happens?
Absolutely. There's a little bit of a learning curve for a lot of different people, especially if they're being brought in last minute, like the CPA, right? And a few things just to put them at ease. What is the history of the deferred sales trust? Well, it's been around 26 years now, 25, 26 years, going on 26. And has it ever been tested by the IRS? I mean, are there enough of them out there that the IRS has actually looked at it, that the IRS has either reviewed it or audited? And again, based on the game of large numbers, if it's been out there enough, this is an important thing. Like, is it out there enough that it's been tested? And the answer is yes. And not only once, not only twice, up to 22 times, it's either been reviewed or audited. Now, what were the results of those audits? An important question, right? Every single one of those, whether it was just a review or an audit, came out with a 0 findings and a 0 change. And what is that, Brett? What is a finding? What is a change? I mean, people ask these questions and they need to know how significant the answer is, right? So a finding means, hey, they found something that was wrong. It's pretty self-explanatory, right? It may not be that egregious, but it was wrong. A change is that it was so egregious that something's not going to work. Not only was it wrong, but it may become disallowed, or it may require something rather structural or substantial that in order for it to be effective, it has to be changed. And neither of those two things happened with the deferred sales trust. And let me tell you how uncommon that is now, so that you again understand the importance of those results. How uncommon is it that an auditor who is doing a review or is doing an audit would have a 0 findings and a 0 change? Well, Brett, having worked with a very large association of accountants, national, over 10,000 accounting firm owners, members of this association, they had me review their list. Now, I didn't go through every single one myself, but they had a list of 400 and something strategies. I think 423. And out of that list of strategies, there's a lot of things there that all of us are pretty familiar with from just normal common tax strategies, as well as some lesser known items that maybe not everybody knows about. Of that list of 423 strategies, only two items out of that entire list have a 100% track record with the IRS, meaning that there has never been any findings, never any changes based on those strategies. So when I say stuff like that to a CPA or a tax attorney or somebody who understands this, their eyes just light up, and it's almost like a huge pressure is lifted off their shoulders, because they were nervous. They were like, I don't know if I should, be on board with this. I might have to do months of research. And just a few little details like that usually puts them at ease. Usually they want to see some evidence. They want to, confirm what I'm saying. I'm not just believe it, right? Which is perfectly fine. We like to provide that. But those are some of the big highlighted items that help put other professionals at ease and usually allow us to work very well together to help make this happen for the.
Yeah, very well said. And I also found too that 9 out of 10 CPAs, if they spend some time, and if you are the client, you bring your CPA in and you pay him for his time to research this, that they end up joining us, meaning they end up sending us referrals, and they actually end up thanking their client for bringing them something that is actually this good and this real and this great track record. So that's definitely a big thing. I would also say that it's not just us saying it, right? There's national law firms that review this. There's movie stars that have used this, that have hired big time law firms to do $100,000 of worth of due diligence. There was a $45 million deal done in Southern California 2 years ago, and that was a big deal that they were very cautious and skeptical. But after they did the review and signed the NDAs, they ended up, they closed it. And I would say if you have enough time, that's really the biggest thing. And this is part of why we work on a conditional basis, meaning if for some reason you don't want to use the DST, or for some reason the deal falls apart, or you run out of time, you don't owe us anything. So we work on a conditional basis, but we do set everything up prior to. In fact, Jake and I just got off of the call with a gentleman selling a business, and he is looking to exit in about a week. The good news is the buyer hasn't removed contingencies, so we do have some time to put everything together. But it's a substantial amount of tax. It's a multiple $1 million sale. It's hundreds of thousands of dollars of tax, and it's a big part of his family's financial future and ability to live comfortably and have some freedom with their time and their energy. And so that was the question, Jake. He said, how quickly can we put this thing together? So what's the timing of this thing, Jake? If somebody is interested and wants to get forward, how quickly can we move?
A lot of times, Brett, we like to say that we like to be there 60 to 90 days before the transaction is finalized and done. However, it's not so much a time situation as it is getting certain things checked off the box, so to speak, getting certain boxes checked and getting things done. And in fact, we had a conversation this morning with a business owner out of Washington State, and essentially he closes the end of next week. And we're meeting him for the first time today. They're organized enough and their CPA has things together well enough. And in the process of the contract, not all contingencies are removed. And so even that short time frame, we can make that work, even though we say it's not ideal. But typically, I think the tax attorney mentioned that with a couple days to spare, we should be able to get that all done.
Absolutely. I'm going to open up for questions again from anybody. Questions, thoughts, comments for Jake or I on the deferred sales trust. We're here to answer those. If you might even have a live deal, and we love live deals on the mastermind because everybody benefits from hearing the particulars, right? And the understanding the nuances there as we kind of look again, take this little Rubik's Cube and try to make it more congruent on the sides of whatever you're trying to achieve with the tax deferral. So does anyone have a live deal? Does anyone have something you want to ask, comment on? Please either put it in the chat or just unmute yourself and say hello. We would love to hear from you. By the way, this happens every Friday, 10 a.m. Pacific Standard Time, 1 p.m. Eastern. This is the Deferred Sales Trust Mastermind. And for those who don't know, I'll use this time as an opportunity to promote the book. The book is coming out soon. And in fact, we have the Jake Mellor in the book, as well as the Kevin Harrington from Shark Tank. And it's my book called Building a Tax-Deferred Exit Strategy. And the goal is to give you a proven playbook for unlocking your ideal wealth plan when selling assets of any kind for yourself or your clients. And so look for that on Amazon and on the website, capitalgainstaxsolutions.com, here in the near future. That being said, I'm going to start calling on some people just to see if I can get somebody to say hello besides Jake, right? Because Jake and I are on calls every day, and I love hearing his voice, but I've always loved hearing more people's voices. So we got Jay, we got Maria, we got Angie, we got Sylvia, we got Surinder, we have Alexandra, we have Dennis. Anybody want to say hello, questions, and no worries. If not, I'll have Jake bring up something that he would like to talk about.
Question. I have a client who's American, lives in LA, but has multiple, like 6 or 7 properties down here in Cabo. I was talking about getting rid of some of them. How does it work for foreign property holdings for American citizens?
Let me talk about a client real fast. He has German descent, California resident, and receiving an inheritance, so to speak. Basically, 5 large properties in Berlin, that are being sold, and he gets 1/7 of each of the proceeds, right? So likely $5 million deal coming to him. And since it's coming from out of the country, but he is a U.S. resident, a lot of times there's a foreign income tax credit that we have to maneuver around and make sure of. Because if they're going to be paying taxes, say in Mexico or Berlin or wherever, right, then there might be an offset. And so it may or may not be needed depending on the country where the property is. In this scenario, they had a capital gains rule. If the property's been owned for over 10 years, you don't owe capital gains in Germany. So then it would be fully taxable without any foreign income tax credit in the state of California, as well as by the federal government. And so he had like this perfect storm where a deferred sales trust made perfect sense for him. Now, your client, we would have to see first and foremost, well, the property is there in Cabo. We'd have to see what the tax ramification is in Mexico. Oftentimes it's around 33%. Now, if it's 33%, something of that nature for the properties held in Mexico, and he pays that tax first, and then the proceeds flow into the United States. The United States is notorious for taking global income and taxing proceeds from any different direction, but there is a foreign income tax credit that might pass through and offset what his tax liability would be. Now, being a California resident, even though the tax might be somewhat high in Mexico, it may not completely offset all of the tax ramification in the state of California because of that extra California 13.3% or whatever, in addition to the Obama tax 3.8 in addition to the 20%. And so again, we have to run the numbers, work with their accountant. We're happy to work with their accountant. If they don't have an accountant, we have teams of accountants that can work with them. And we can actually do an estimate to see if the tax paying and the tax flow is significant enough to warrant the use of the deferred sales. And that actually sounds like a pretty exciting client.
Candace, did that answer the questions or have more? Or what were your thoughts on that so far?
No, that's perfect. That gives me kind of a basis point. Yeah. And Jake, I want to talk more about this client with you later. Out of the 6 properties, he wants to keep 3 and turn them into a beachfront event spaces and build them from the ground up. He's owned all the properties for about 20 years and he wants to offload the rest of the properties because he hasn't done anything with them in the last 20 years. But now he's feeling old and he feels like he has to do something with all this stuff that he has.
The deferred sales trust is definitely a financial tool, if I were just to really simplify it, that allows people to divest of current assets and reinvest in other assets without incurring that tax hit. Obviously, when we're working across borders, we can't control what other countries do, but we can control what the U.S. tax ramification would be with the deferred sales trust.
Okay.
Although it is important to mention too, Candace, I have a quick question just to see if you could add some more value to him. You say he has 6 properties. What would you say the total value of those 6 properties are?
The one beachfront in Cerritos has got to be a $6 million property, at least freestanding, just the one property from my understanding. Okay. His family, his dad was a LA plastic surgeon, invested in tons of real estate down here 20, 30 years ago when there was, only Cabo was only half built at that point. And they were able to land 3 beachfront properties, large ones, and they're currently all undeveloped. So the potential there is huge.
So he's looking to unlock that $6 million that's been tied up, tax and not have flexibility, and then use that to go build on those other three properties.
I think that's from what I understand.
He's
a little all over the place in his ideas. The guy has a lot of ideas, but not a lot of direction, which I guess is where the lunch with me came in.
Yeah, his situation probably looks a little bit like this, right? It's a Rubik's Cube with a lot of different colors, a lot of different movements, and so that's part of why we love to solve that problem and earn the right to be a part of his dream team. But just so everyone understands what the ability what the deferred sales trust can do, you have the opportunity to not only help him unlock this capital, but then to be able to accomplish what he's been wanting to do, which is build these other lots that are beachfront that they've been able to for many, many years. You see most, in fact, every single 1031 exchange requires equal or greater value when you go to trade something, right? So if you sold that property for $6 million, that means he needs to go buy something new, by the way. You can't buy into an existing property. Like you can't use this $6 million to develop on that property that you already have. It becomes too complicated, and there's a lot of rules for that. However, the deferred sales trust, that $6 million can go into the trust, then that capital can be used to build on the projects. Now, let me ask you on those other assets though. How does he own the other 3 lots? Are they in LLCs? Are they it's individual name?
We haven't got that far. He was he took me to tour one of the beachfront sites because he wants me to be part of they're building it. He's a lighting guy from LA, 40 years in the movie industry. And so they're gonna build like a rustic wedding venue out there. Mm-hmm. He was more interested. I do charity fundraising and event planning for the government back in Canada. I work with members of parliament to secure funds for nonprofits. Mm-hmm. So he brought me into the team to do exclusive rights for all his event planning. And he wanted me to come in and build the websites and all that sort of stuff for all 3 of his properties. So we haven't really delved too much into the other stuff, like what his plans are for the actual building, because I came in as a different part of the team. But he needs a lot of direction and a lot of guidance. He's got a lot of ideas, but he's not sure how he's planning on executing anything really at this point.
Got it. And also too, is he a U.S. citizen and a citizen of?
I know he's a U.S. citizen. He's been coming here for 22 years. I don't know if he's just been doing that on a tourist FMM or if he has some sort of residency. Mm-hmm. Those will be part of my follow-up conversations with him.
And so, and if he's not, he can still use the deferred sales trust. In fact, it becomes even more valuable for him. How old is he?
I'm saying late 60s.
Okay. And here's a thing that's another thing to think about. So the thing called estate tax. And so estate tax has everything to do with your total value of your estate when you pass.
Mhm.
And if it's greater than 22 million married, if you're a US citizen, then you pay 40% on that. That's inside your taxable estate. 12 million single, although those are set to cut in half in a couple of years. Here's the tough part. If he's not a US citizen, you have none of those exclusions. In fact, it's only like, I think it's 65 or 68,000.
Right.
So let's just do the math here. Let's just say his 6
Oh,
properties.
he's definitely a U.S. citizen.
Oh,
He
okay.
was born and raised.
That's good. So then he doesn't have, but imagine you know someone else from Canada or whatever else that owns
Yeah.
assets in America or from anywhere and who's not a U.S. citizen. They are subject to the United States estate tax, which essentially you have no exclusion. So imagine this client was not a U.S. citizen and all of his values of all of his properties are 15 million. I'm just throwing a number out, right?
Yeah.
And that would mean 40% of the 15 million would be gone. Like if he didn't use the deferred sales trust, I mean, he would, if he dies, he'll die. We're all going to die, right? Upon death, 40% of 15 million would be $6 million eliminated. I mean, no stepped up basis solves this. No 1031 solves this. The deferred sales trust does solve this without buying life insurance, without giving it all away to charity, without having to gift it to anybody. You just can. Now, it does take an exit. It does take a sale. So you'd have to sell the assets. Now, in this scenario, it sounds like he is a U.S. citizen. And if he's married, is he married or single?
Single.
Okay. So that means the 12 million would be excluded at this point, although it's set to drop to 6 million in 2025. So those are just some of the things to think about as you're exploring these things. Most of the things I would say, Candace, is just kind of take the temperature, get a feel for where he's at, and bring him to the call with Jake or I, or both, and then see if we can't try to help him, if that makes sense.
Yeah, definitely.
Great questions, great thoughts. Thank you for sharing, Candace. Who else has thoughts or questions? You can unmute yourself, say hello, jump on in. We're in the section of the mastermind where it's kind of open office, open forum. Anybody,
discussion, yes.
Open discussion that can jump in. And by the way, you can go to capitalgainstaxsolutions.com to get started on your deferred sales trust. You can also find Mr. Jake Mellor at strategictaxsolutions.com. That's strategictaxsolutions.com. Jake is the financial advisor. I'm the trustee. We work together to help individuals defer the capital gains tax on the deferred sales trust and so much more. And then we work with professionals to help them unlock deals for their clients and solutions so they can win more business as well. So, yeah, we see some new people joined. We got Jonathan. Welcome, Jonathan. We've got, we still have Dennis here. We have just joined.
Cameron Reed, but his audio is not able to join.
Oh, hey, yeah, Cameron. Yeah, we see you trying to come in. You might have to, if you can hear us, you might have to jump out and then jump back in. That could get you maybe a chance for Zoom to say yes to you. So who else has questions or thoughts for Jake or I?
We have Unicia Parrott that we haven't heard from for a little while, who's here.
Hey guys, no questions from me. Not at this juncture. I'm working with multiple different clients at different levels, but the deferred sales trust is definitely that's forefront and center for me. Also, I'm married to a fellow EXP guru. He's pretty high up with you guys, or with EXP, that is. And so I'm trying to actually bring him into the fold as well, because we're in Georgia and he has quite a few clients that have started moving here from either California or New York or some of the higher tax bracket states, but also the states where the property prices are much higher as well. So I think there's going to be a ton of opportunity in the future. So if you guys don't mind, I'll just be a fly on the wall in the meantime.
You don't mind at all. It's our pleasure to have you. Thank you for sharing that. And by the way, it also works for public or private stock, for those who are wondering. And that is pretty cool. So if you own public or private stock, the deferred sales trust can work for that. Of course, cryptocurrency, businesses, real estate, primary homes. Very cool. So thank you for that. Who else? Anybody else? Questions, thoughts, feedback,
So
concerns?
in regards to what Alicia was mentioning, there's an interesting thing that we can help assist or at least encourage the effort towards, and that is Nexus. A lot of these higher taxing states, where if you have property and real estate there and you sell out of that, a lot of times those states try to claw back. Some of the most notorious, of course, California being there at the top, right? They really, really have a long memory that you had a property there and it sold, right? The really nice thing about the deferred sales trust since it handles a number of different assets internally. We're not recognizing the sale of one property, and we might reinvest the assets in properties in other states. And so there is a point at which the Nexus possibly could be changing, which would be of great benefit to some of those clients who might have sold a property utilizing the deferred sales trust way back when. Of course, the individual's domicile, a lot of different things play into what is Nexus, right? And I just wanted to throw that out there as a little teaser that some people with some of these ultra high, several millions of dollars of transactions, whatever, Nexus becomes a very important topic that we work with a tax attorney to help provide some additional strategies in regards to the deferred sales trust that may assist in changing Nexus.
Yeah, that's a great point. Like, so if you sell an asset in California and you move and establish residency in Nevada, immediately you can take advantage of the income of the interest on the payment of the trust to pay you in the state that you reside in. And so I actually had a client, we still helped him sell an $8.3 million primary home in Palo Alto. And then he moved to Henderson, Nevada. And so he's taking interest payments when he established residency in Nevada, which lowered his income tax because he's no longer a California resident, right? So the interest payments off of the trust are ordinary income. If you dip into principal, it's capital gains tax. So to be clear, it doesn't mean he can just move to Nevada and pay no capital gains tax to California if he dips into principal. That's going to follow him there. But if he doesn't touch the principal, in other words, keep the capital gains tax deferred and just lives off the interest payments, his Nexus is Nevada, therefore he's paying Nevada income tax, which guess what it is? It's zero in Nevada or even Texas or Florida, right? These lower income tax states. He'll still have federal tax, but that's a substantial savings for him and a great way to maximize the value of his equity in there to grow more for him and live off of. So that being said, who else has any questions or thoughts on anything of what I just said or Jake just said? We're here for you.
It's been a pregnant minute since we heard from Sridhar. I'd like him just to say hello if he doesn't mind. In the world of education, a lot of times people are working while listening to us, Brett. Mm-hmm. And when I say working, sometimes working out in the gym, they hear us on the podcast, sometimes working out in the office, and they have us here on one monitor while they're speaking to clients on another monitor. So I've talked to a number of individuals who sometimes call me back later saying, hey, I wanted to ask something, but I was so busy with a client. But Sridhar, you're here right now. Go ahead and say hello.
Hi, Jake. But I don't know if anybody knows about me. I'm from Dallas, Texas. I'm a multifamily investor. So basically, I connect with a lot of people who come across with 1031s, and then I try to educate them. And then I'm trying to bring them onto this meeting so that they'll also take benefit of the DST as well. And the good thing is that someone asked me the similar question I had this morning regarding the international funds coming back to US, how to do that. Well, I'm glad. Thank you guys. Yeah.
Glad that could be helpful for you. And of course, if anybody is coming up on a transaction here in the next little bit, and they was just like a 1031 alternative option, definitely, introduce them to Brett, introduce them to me, and we can have that quick 20-30 minute conversation to find out if their deal is first and foremost a good qualified deal for this type of strategy, and second, if the tax paying or the flexibility of the DST versus 1031 is a big game changer for them.
Excellent.
Appreciate your comments there.
Anybody else? And we can always end early too. We don't need to go the full hour. Like this, we'll give you the 17 minutes back on top of your hour, which is totally cool. I'm looking forward to the next couple of weeks. We've got some closings happening and reporting back to everybody. But if you guys want to learn more, of course, you can subscribe to the YouTube channel, Capital Gains Tax Solutions. You can also, again, check out the book that's coming out here pretty soon, Building a Tax-Deferred Exit Strategy. And then, of course, invite more people to this. Just keep coming back. We appreciate everyone out there. Jake, if people want to get in touch with you, where's the best place for them to find you?
There's an appointment link on my website, strategictaxsolutions.com, as well as we have an 800 number, 1-800-773-1848. Most likely, Carly will answer the phone and book an appointment.
Perfect. And then again, if people want to get in touch with me, go to capitalgainstaxsolutions.com. So we appreciate everyone out there today listening, wherever you may be consuming the content. Please rate, review, subscribe. Please share it with someone that could help. And then please invite somebody and register totally free to come to the mastermind every Friday, 10 a.m. Pacific Standard Time, 1 p.m. Eastern. And we will talk to everybody really soon. Thanks, everybody. Bye.